Because of the uncertainty, AT&T stock has plummeted in value over the last year. They announced in May that they will spin off its Warner Media division and merge it with Discovery, creating Warner Bros. Discovery. In addition, it was announced that after the deal is completed, which is expected to be somewhere in the first half of 2022, the dividend will be reduced. All of this raises a slew of questions. What will the deal structure be? What the business will look like in the future? What does this imply for investors? And what is the expected dividend in the future? All of these concerns sunk the rock, resulting in a 25% drop in value from the time the deal was announced to now. However, as we got closer to the closing sale, the uncertainty began to fade. When it hit a low of $23 per share, investors realized it had been oversold. Both companies have the potential to be extremely valuable in the market. The stock price rose 23%, still a huge drop, but it appeared as if a turnaround was on the way, especially when the deal was completed. Then John Stankey, the CEO, revealed a bombshell. AT&T officially released its fourth quarter and full year earnings for 2021. Despite the fact that the company fundamentals were all excellent, the stock price decreased by almost 8%. You may inquire as to why. There was a new level of uncertainty imposed. In this video, I'll go down the earning figures and explain why CEO John Stankey's comments caused the stock to drop by nearly 8%. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is released. If you're ready, let's get to the topic. AT&T's fourth quarter results were excellent. Across the board, they outperformed analyst expectations. Revenue of $41 billion exceeded expert expectations by $550 million. Earnings of 69 cents were reported, compared to a loss of $1.95 in the previous quarter. The figure covers both earnings and losses on investments. The adjusted earnings per share came in at 78 cents, up from 75 in the previous quarter. For the entire year, free cash flow was $8.7 billion. The end outcome was quite satisfactory. Due to business diversity, revenues came in at $168.9 billion, down slightly from $171 in 2020. Reported EPS of 2.76 cents compared to negative 75 cents in the prior year. Adjusted EPS of $3.40 compared to $3.18 in the prior year. Total free cash flow of $26.8 billion, down slightly from $27.8 billion last year. When considering all of this, keep in mind that AT&T is not a growth company. It is a dispensable cash flow generator. Apart from pure financials, the actual company situation is good. In the fourth quarter, the business reported 884,000 postpaid phone net additions, bringing the total to 3.2 million for the year. This was the greatest total in more than 10 years according to the firm, and that is fantastic. A low churn rate of 0.85% in the fourth quarter, even lower for the full year at 0.76%. 1.3 million total postpaid net adds in the fourth quarter and 4.5 million for the full year. Revenue and operating income and mobility are up over 5% with an operating income margin of 25.3%. In the fourth quarter, the business added 270,000 fiber subscribers, bringing the total number of net adds for the year to 1 million. Warner Media has reached a total of 73.8 million HBO subscribers worldwide. The number was higher than AT&T's forecast of 70 to 73 million subscribers in September, and it's up by 13.1 million year over year. The average revenue per user was $11.15, which is among the highest in the business, trailing Netflix and Hulu by not much, and considerably ahead of Disney Plus at the moment. Let's hear AT&T CEO John Stankey's thoughts on the quarter.
More postpaid phone net adds in 2021 than we'd done in the previous 10 years. It was our fourth consecutive year of over 1 million fiber broadband net adds, and we're now increasing the footprint and have an opportunity to ramp that up. And look, at 13.8 million HBO Max ads and what we were able to do to launch on 2 continents and ultimately broaden that product and not only be a subscription-based service, but have advertising support associated with it. Look, it was a home run for the team this year.
I agree that this is a fantastic execution. The communications industry is in better shape than it has been in years, and the streaming industry has proven that it is a serious participant and is here to stay. According to John Stankey, the media industry is grossly underestimated.
When you look at valuations of kind of where Netflix stands today versus maybe a valuation of the components of At&t that are represented by media, or when you think about the combined Discovery Warner Media, there's a pretty big chasm between those two valuations. And my belief is they've built an incredible franchise, and there is a great business in distribution direct to consumer. You've heard me say it before. I don't think it's going to be a business that there'll be 6 or 7 companies that are successful globally, but just a small handful, and it's a race to see who establishes themselves. I believe in 2021, we clearly indicated that HBO Max and what we're able to do on that platform will be one of those. I'd like to see our valuation actually start to edge up to what Netflix is.
Warner Media, as well as the upcoming Warner Bros. Discovery organization, are unquestionably undervalued. Today, I don't think they deserve to trade at Netflix multiple, but they certainly deserve to trade at a higher level than it is now. In the media industry, I think that there will be a lot of consolidation. Netflix and Disney are the most well-positioned pure media corporations, while Warner Bros. Discovery is a solid third. The agreement between Warner Media and Discovery was formed with the goal of unlocking such value for shareholders. The idea is that At&t and its media company would be more valuable if they were sold separately than if they were sold jointly.
You know, I made it very clear that we were doing what we thought was the right thing to unlock value for the shareholder for the near and long term. And we understood that there were a lot of moving parts. This is admittedly, to do this and structure it in the right way and avoid things like tax leakage so that all that benefit flows back to the shareholder. There's some moving parts to this deal. And there's some moving parts in restructuring what I would call RemainCo At&t to make sure that the capital structure is set up properly. I'm not surprised that it went on. Obviously, in my job, I would have preferred that it didn't and that there was a little bit more stability around it. But I do believe what we have set up in the combination of Warner Media with Discovery, the RemainCo At&t and its focus, and the respective capital structures and charters and missions for each of those companies is a very, very compelling value-creating equation. And what I believe we're seeing right now, as you alluded to, as we get closer to the close date, as the uncertainty comes away, as all the questions about whether or not this is going to happen and when it's going to happen, I think we're now seeing investors look at it and say it is compelling.
And it is on point. The stock price dropped due to a substantial amount of uncertainty, but that uncertainty has been diminishing as we come closer to finalizing the deal. However, in the following footage, Stankey is asked a question that adds to the market's confusion.
One of the key questions among some of your investors certainly is whether you're going to do it as an exchange offer or a spin, essentially a split or a spin. I know you're not ready to share that decision, but can you at least share some of the thinking behind either one of those? Because they both have their benefits and or potential drawbacks, whether you simply essentially give a share, a percentage share of Discovery, Warner Discovery to each of your shareholders, or actually do an exchange offer whereby you really would end up retiring potentially a good amount of At&t shares.
Yeah, we kept that option open for good reason because we wanted to assess what the state of the market was as we got closer to the close of the transaction. When we think about going through the dynamics of a split, it's what you said earlier, which is we'd like to possibly over time reduce the At&t share count, and this may be one way to do that. However, it is a very, very large split. It's unparalleled in terms of anything that's been done ever in history. And, that certainly gives me some pause. And we have a very large retail base in the At&t stock right now as well. And that retail base sometimes isn't quite as deep in some of these issues as the institutional base is. And so I'm very mindful of the fact that whatever we decide to do, it has to be something that can be clearly communicated so that there isn't confusion in the marketplace and a lot of people carping. One of the things that's guiding us is, as we started this, we wanted to do this for shareholder value. Everything we're doing right now is about shareholder value. As you know, to execute a split, especially one of this size, it would require some value leakage to execute that and actually get the shares placed. I'm not sure I'm really a big fan of that value leakage dynamic right now and being second guessed on it. I'm also pretty interested in moving through this as quickly as we can. There's some advantages to doing a spin in terms of how mechanically it can be done and how much quicker it can be done.
This, in my opinion, is the statement that caused AT&T stock to plummet by more than 8%. Let's start by distinguishing between a spin-off and a split-off. A spin-off is a new firm that distributes shares to existing owners. It would just appear as a disbursement in your account. Based on their previous declaration that AT&T shareholders will receive stock representing 71% of the new firm, this is what the market and I expected to happen. A split-off gives shareholders shares in the new firm, but they must choose between the subsidiary and the original company. Extremely distinct. I've never dealt with a split-off before, so I have no idea how it feels from the standpoint of a retail investor. I'm undecided about which entity I'd prefer to own. I'd like them both. Fortunately, it appeared that Stanky was leaning toward a spin-off. This is not good news in the short run. It introduces a new level of ambiguity. Following AT&T stock has taught me about an enormous detrimental impact uncertainty that can have on a stock price. Having said that, this uncertainty could result in a long-term purchasing opportunity. So what am I going to do now that nothing has fundamentally changed in the business? I'm planning to reinvest my dividends in the company to get more shares at a terrific price. If the stock continues to fall, I may purchase more shares. And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, don't forget to subscribe to the channel by clicking the subscribe button below. Turn on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and we hope you had a great time. We hope to see you again soon.